our next topic is audit evidence. So you have evidence. You see, auditors are supposed to do audits by obtaining sufficient appropriate audit evidence. And that based on those evidence, the auditor come out with his opinion. Therefore, we are going to learn, now that we plan, the next thing for us is to what? Go to the field and obtain our audit evidence. So the first thing is audit testing. You need to test the system or to test transactions. And then you come out with your what? Test results. The test results will go into the what? The opinion. So the testing goes with gathering audit evidence. So if you are testing, means you are obtaining what? Audit evidence. The auditor will what? Therefore collect evidence on which to what? Base the audit. To base the report and opinion. So that's it. So if you gather enough and sufficient and appropriate, that's the word, evidence that will be relied upon, you can easily report and give your opinion. The auditor carries out procedures known as audit tests in order to create this evidence. These tests could be what? Tests or controls, that's the first one. You can test the system, the controls put in place by management. Yes, you test them and the controls are working, then that is another evidence. Then you can also test of what? Details. Test of transactions and balances. That is test of details. So you move and test transactions into detail. Analytical procedures are also carried out. Analysis, which is analytical procedures, but not typically on a sample basis. So what they are saying is that you can do analytical procedures. You can break down the financial statement into what? Last year, this year. Or last 2 years, last year and this year. Or you base it on what? Industry against what? Your firm. Company A versus Company B. This is analytical procedure. These are revised later. Okay, don't worry. Analytical procedures together with tests of detail are referred to as substantive what? Procedures. So analytical procedures together with tests of detail are referred to as what? Substantive procedures. The tests, the evidence from the tests and the conclusions that have been drawn must be documented. So as part of the audit, any test you do, any evidence you obtain, and they must also go into what? Any conclusion you reached, you need to document them. Any test you do, any evidence you obtain, and the conclusion you arrive at should be documented in the audit files. Audit evidence. What is an audit evidence definition itself? This is any information used by the auditor to arrive at the opinion on which his opinion is based. Any information. It can be photograph, it can be anything. It can be photocopy, it can be any information. It can be verbal, it can be written, it can be anything. Any information that you rely on to come to what? To your conclusion. That is what we call what? Audit evidence. It includes information in the accounting records. Any information in accounting record. And other information. All these things go into what we call audit evidence. Then audit sampling. As I told you from the beginning that auditors is scarcely before they will do 100%, unless the business is very small and the transactions are not many. If the business is like, let's say, Ghana, let's say MTN or Vodafone, or let's say electricity company of Ghana, I doubt if the auditor can do 100%. It is not likely. So audit sampling is what we normally do. So in sampling, in selecting some few items for what testing, that is what we call sampling. This is the application of audit procedures to less than 100% of the population of transactions and balances. such that all units have a chance of selection. Again, this is revised later in this session. Okay. ISA 500 and the financial statement assertions. For the auditor to do his work and obtain sufficient appropriate audit evidence, he has to what? Rely on assertions. So they are saying that ISA 500 audit evidence set out the objective of the auditor as being to design and perform audit procedures in such a way as to enable him to obtain sufficient appropriate audit evidence. So your designing of the audit procedures, your testing and the rest should what? Be sufficient and be able to give you appropriate audit evidence. In order to what? Be able to draw reasonable conclusions. That is one of the reasons. And then on which to base his audit opinion. These are the assertions. So once you are able to obtain sufficient appropriate audit evidence, and you, in order to be able to draw reasonable conclusions, then you can now put in your audit opinion. The auditor is required by ISA 500 to design and perform appropriate audit procedure for the purpose of obtaining sufficient appropriate audit evidence. Other requirements of ISA 500 are as follows. You must consider the relevance and reliability of the information to be used as audit evidence. So audit evidence is information on which the auditor relies on to come out with his opinion. Therefore, they are saying those information, those evidence you are obtaining should be relevant, and then it should be reliable. Then the next one is, if information to be used as audit evidence has been prepared using the work of management experts. If you are going to rely on the management experts, then that is when using information produced by the entity, evaluate if it is management expert, you must evaluate what? Whether the information is sufficiently reliable, accurate, complete, precise, and detailed. And then use effective means of selecting items for testing. Yes, you don't just go and select anything for testing because you are doing sampling. You should use effective means of selecting items for testing. Then, if audit evidence from one source is inconsistent with that obtained from another source, check all those things. Use of experts by management. So you see, we normally use management always use experts in coming out with information. So when assessing objectivity of our experts employed by management, issues for the auditor to consider will include the following. Experts, that's management use experts in coming out information. So they are saying if management uses experts, for you the auditor, find out if the expert has a financial interest in the audit client. For example, a shareholding. Find out if that expert giving the evidence, then if he has a financial interest in the audit client. The second one is the expert has a personal relationship with senior manager in the client audit clients. The fee paid for the expert services was a fair commercial price. Check all these things before you accept that management experts evidence. Any evidence from experts that management has, an expert that management has produced, given to you, please check. When assessing whether the work of management experts provides sufficient appropriate audit evidence for audit purposes. So, for you to accept that expert's job, you must assess the expert's, whether he has financial interest in the company, and so forth and so. They have any relationship, and so forth and so forth. When they say sufficient, what does it mean? Sufficiency relates to the quantity of evidence, quantum, the amount of evidence you obtain. There must be enough audit evidence to support the auditor's what? Conclusion or opinion. Let's say, for example, you want to say that you are earning 500 Ghana cedis a month. What is the evidence that that is the money you are having? One, pay slip. First of all, you yourself said it. That's one. Two, pay slip. Three, you go and then somebody from your place also confirm that. So you could see that with all the three, you are earning 500. It is sufficient. Sufficient means quantity. And then appropriate relate to quality. Which means it is relevant and it's reliable. So for you to be able to rely on any information which you give as an evidence, the information should be what? Appropriate. That means you have a quality. And then the what? It should be reliable, which is what? Reliable. It should be quality. So appropriate relate to quality, relevance, reliability of the evidence. Then continue. The auditor will need to exercise his professional judgment. So I told you guys from the beginning of the that was the previous lesson that we have professional judgment on both of these aspects. What I mean is that the auditor will need to exercise his professional judgment on both of these aspects in deciding whether there is enough evidence to support a conclusion. So it is you, the auditor, who will determine whether you have got all the necessary evidence. Is there enough evidence to support a conclusion? That is the question. What is the quality of a given piece of what? Evidence. And is this sufficient to justify the audit opinion? All these things you need to consider them. The two characteristics of quantity and quality are also interrelated. An auditor may be able to reach a justifiable conclusion based on a smaller quantity of high quality evidence. So if you are relying on just a small quantity of what? Evidence, then the evidence, the quality should be what? High quality. The quality should be very high. And then a larger quantity can also do. If a larger quantity, so they say, however, a larger quantity of lower quality evidence may be required to reach a justifiable conclusion. You can rely on an evidence when you have enough. Factors that may influence the sufficiency of audit evidence include what? Materiality of the item being tested. Materiality of the items being tested. And I told you from the previous lessons that when they say materiality, we have two types of materiality, quantitative and qualitative. And then we have the level, what you call performance. We have overall materiality and then performance materiality. Then we have financial position of the client. Yes, if the client is well-to-do, it will also go into what? Influence the evidence you are getting. Condition of the accounting and internal control system. Condition. If they have an effective internal controls there, it will also show the type of evidence you are looking for. Persuasive of the audit evidence obtained. Yes, the audit evidence will be able to persuade you. And then population of the item you have chosen and the level of audit risk involved. All these things need to be considered. The reliability of audit. How do you rely on audit evidence? Audit evidence is more reliable when it is obtained from what? Independent sources. So it means that if you obtain some information, confirmation from outsiders, it's more reliable than audit information you obtain within the organization. Audit evidence obtained directly by the auditor is more reliable than what? Audit evidence obtained indirectly. So if a client gives you information, vis-a-vis you yourself testing, you have tested, and what you got is more reliable than the one that is given to you. The audit evidence is more reliable when it exists in documentary form. Yes. If the thing is not in documentary form, it becomes a difficult issue there. So every audit evidence should be in what? In a documentary form. But some of them may not be documentary, yet it will be reliable. Once it's recorded, it is in document. Audit evidence provided by original document is more reliable than audit evidence provided by photocopies. Yes. That's why always auditors, when you give them photocopy, they say, what is the original? Yes. Because you can't rely on photocopies. Original documents are more reliable than photocopies. A number of audit testing procedures are what? Available to the auditor as a means of generating audit evidence. So there are so many means by which you can obtain your audit evidence. More than one procedure may be used in collecting evidence in a particular area. Yes. You can use different way of collecting in the same transaction, with the same transaction. Not all procedures may be appropriate to a given objective of audit. Yes. The auditors should select the most appropriate procedure in each situation. So when you are going to select item for your what as evidence, select the appropriate what? Procedures. There are 7 main testing procedures for gathering what? Audit evidence. So in obtaining your audit evidence, there are so many ways you can do it. 7. So one of the all the procedures we are going to discuss, 1 or 2 can be suitable for a particular evidence, but some of them may not be appropriate for the particular evidence. Okay, so in selecting the main procedure for obtaining that evidence, the onus is on you as auditor. One of the means by which you can obtain evidence is inspection. You go and inspect the transaction or whatever is there. Inquiry, you can also ask management or those relevant people, those who are important in the system. That's you make inquiry. Then recalculation. You can recalculate or recomputation. That's where auditors, when they come, you have done your whole calculations. They will even take their calculator and recalculate to confirm what you put there is correct. Then you can also go and observe as the transaction takes place to see how they normally do it. Then you can also write a letter to confirm some things from outside, like payables. If they have payables in the book, you can write a letter to all those who are debtors to confirm the figures. That is external confirmation. Then rate performance. Rate performance relates to the internal controls, the system. So the procedure they say that they put in place in performing particular transaction, you also pick the same transaction and re-perform it to confirm what they put now is correct. Then you can also use analytical procedures. Now, financial statement assertions. The auditor should therefore generate evidence designed to reach a conclusion about each of these assertions. What they are saying is that for each financial statement, we have financial statements, we have assertions. So these assertions are set out in answer 315 and fall into 2 categories. Assertions about classes of transactions and events. Assertions about classes of transactions and events. And related disclosures for the period under audit. Then assertions about account balances and related procedures. So, to let you understand this clearly, there are assertions that go into what? Income statements. That is what? Assertion about classes of transactions and events. Classes of transactions and events. And related what? And how they are disclosed in the notes. Then we also have assertions about account balances and related disclosures at the period end. So we say that is the financial statement position assertions. The income statement assertions are for what? Events and related disclosures. Events that took place and their related disclosures. And that of what? Account balances and its disclosures go to where? Statement of financial position. You see, financial positions, in actual fact, they are all the items there are balances. Everything in the financial position is balance. They are all balances. That's where we say that assertions about account balances and related disclosures. So all the financial statement position items, they are all balances. There is nothing that is on its own there. They are all balances. An income statement are transactions and events that took place within the period. So these are the areas you look for. So when you are going to look for evidence, you divide financial statement into two. The income statement, transactions, and what do you call it? Position statement, transactions. Okay? And those position statements, they are only what? Account balances. And the disclosures. Then the income statement one are what? Transactions and events that took place in the year and their disclosures. So we are talking about income statements, position statement, and the notes. Assertions about classes of transactions, events, and related disclosures are as follows. So as far as income statement transactions are concerned, transactions that occur within the period and their disclosures, the assertions that are relevant are occurrence. It is your duty to find out. They are saying that management who prepare the financial statement, I say that the transaction actually occurred. If truly they occurred, you want to find out truly the thing occurred. So how can you do it? So occurrence. Transactions and events that have been recorded or disclosed have occurred. And such transactions and events relate to the entity. What they are saying is that those who prepare the financial statement, you all know that it's management. And management is telling you that the transactions that they have recorded, they actually occurred. If they didn't occur, they will never write or put them there. So it is your duty as an auditor to find out whether those transactions actually occurred by looking at the original documents, the origination, how it came in, and the rest. So to find out whether truly those transactions occurred within the year, and do they relate to my what? Entity. Then they also tell you that the transactions are complete. Whatever they recorded in the income statement, they are complete. So as part of your job is to look around and see whether some of the transactions that they recorded are left out or some other ones are added to it. So all transactions and events that should have been recorded have been recorded, and all related disclosures that should have been included in the financial statement have been what? Included. So it is your duty as an auditor. So you are looking for evidence, and these are the means by which you look for evidence. The occurrence, whether the transaction occurred, whether they are complete. Then they are also telling you that the transactions that they recorded are accurate as far as they are concerned. Management, that's what they're telling you. And therefore, it is your responsibility as an auditor to see whether the transactions they recorded are accurate by recomputing or recalculating some of the figures. So amount and other data relating to recorded transactions and events have been recorded appropriately, and all related disclosures have been what? Appropriately measured and described. So it is your duty to find out if the transactions they recorded are accurate by recalculating or reperforming. Let's come to cutoff. Transactions and events have been recorded in the current accounting period. So, Income statements are periodic statements. Therefore, you have to check up and see if transactions that happened within the period are recorded. Or there is a transaction that was brought in which didn't happen in that particular period. It is your duty to look round. That's why auditors, when they are auditing, for example, 2019, they don't end at 2019. They'll go beyond 2019 and come to 2020 and look for January, February and see if transaction occurred in 2019 and have been recorded in 2020. Then classification. Transactions and events have been recorded in the proper accounts. You know, transactions need to be classified properly. Otherwise, we have what we call real accounts and nominal accounts. Real accounts are the assets, or which we call assets, and therefore the transactions, some of them we depreciate them, others we don't depreciate, and the balances go to what? The balance, which you call position statement. So you have to find out if they classify them very well. If you don't have proper classification, a payment for, let's say, TNT can be capitalized. Once it has been capitalized, it means you have to depreciate it. You have revenue expenditure and capital expenditure. Capital expenditure is supposed to be depreciated, while revenue expenditure goes straight into what? Income statements. Then presentation. Transactions and events are appropriately aggregated or what? Disaggregated and clearly described, and related disclosures are relevant and understandable in the what? Context of the requirements of the applicable financial reporting. Yes, presentation. Our standards, our accounting standards show us how transactions should be presented in the financial statements. Have they been done in the same way as specified by the framework? The laws also prescribe. So have they complied with those standards and the laws before? Then assessing about amount balances and related disclosure. Now we come to what? The position statements. That is, in the olden days, we call it balance sheets. So the first thing you have to find out from the position statement existence. Every item that they put in the what? Financial the position statement, they are telling you that that particular thing exists. For example, assets, liabilities, and equity interest exist. So the onus is on you, the auditor, to find out if those what? Assets actually what? Exist. Those liabilities actually exist. If it is equity interest, that is shares and the rest, you look for evidence for what? Those ones. The rights and obligation. Once the thing belongs to your clients, they have the right to use it. Anybody who say I have the right should have a title or should have a document of ownership to support that. And if it is obligation, your client is telling you that they have borrowed money, there should be documents. And there should be evidence for what? Repayment of that particular money. So all those things are the ways you obtain your evidence. Completeness, as I discussed already, all assets, liabilities, equity, interest, and so forth have been recorded, have been recorded, and all related what? Disclosure that should have been included in the financial statement have been included. So what they say is that they say it's complete. All liabilities, all assets, and equity interest are complete, meaning that they didn't what? Jump over any what? Assets. They didn't what? Jump over any liabilities. So everything is captured, and it is your duty to look around to see if you can what? Find out all the assets, if they are there and they are complete, or they have removed some of them, or they have added something which is not supposed to be added. That is your job as what? An auditor. They also tell you that all our balances that appear in the what? In the that assets, liabilities, and equity interests have been included in the financial statements at appropriate amount, and any resulting valuation or allocation adjustment are appropriately recorded, and related disclosures have been appropriately measured and described. What is telling you that accuracy, which we discussed, that they are telling you that all the assets and liabilities they have recorded in their position statement are accurate. So you read the recomputation, you do reevaluation, and then allocation. Where they are located, you have allocation, which is what? Current assets, non-current assets, current liabilities, non-current liabilities. All these things, they have been properly allocated. Then classification, asset, liabilities, and equity interests have been recorded in the what? Proper books. They have been properly classified. Then presentation, assets, liabilities, and equity interests are appropriately aggregated or disaggregated and clearly described and related to disclosures. That's notes to the accounts concerning those items are properly done. It is your duty. We have what we call testing, directional testing. Directional testing is an audit approach which is to provide a framework, or which is to provide a framework for what? The conduct of an audit. Conduct of an audit. The main advantages are that it helps the auditor to clarify the audit objectives. It also focuses the audit work on areas of high audit risk. So when you are going to do direct testing, it will help you to what? Clarify the audit objective, and it will also help you to focus on the audit work on areas of high audit risk. Since you know the risk, you know the risk profile of your client, high risk areas should be given more attention. That's the direction you go. It links together the results of audit tests. And then directional testing has its foundation in the fundamental principle of double entry bookkeeping, whereby for every debit entry, there is what? A credit entry. What they are saying is that in the olden days, we have debits and credits accounts. So if you see a debtors figure inflated, once it is inflated, it means it has started from somewhere and it's come back to debtor figure. So meaning that probably individual accounts have been what? Inflated, which goes to debtor figure. Directional test is therefore based on the following approach to the results. If all asset balances and expenses for the year are tested directly for overstatement, and all liability balances and income for the year are tested directly for understatement. These are the way it goes. Then misstatement in the opposite directions will be what? Tested indirectly. So any debit entry which is very high, the corresponding credit entry, you should expect it to also be high. Therefore, if there is an adjustment, you need to do that. The main focus of directional testing is therefore test debit for overstatements. Every debit must be tested for what? Overstatements. And what? Test credit for what? Understatements. This is because if the statement of financial position, assets are more likely to be overstated and liabilities are more likely to be what? Understated. But that is vice versa. But once the debit is overstated, the credit is also overstated. That's what they're saying. A misappropriation or fraud will often result in an overstatement of an asset or expense. Testing of overstatement of debit balances. A test for overstatement starts with the monetary amount recorded in the financial statement. The direction of testing is then backwards to its source. Such tests seek to confirm existence. Then testing for understatement of credit balances. A test for understatement starts at the source and traces transaction forward to the financial statement. These tests are aimed at ensuring the completeness, accuracy, of recorded transactions and balances. Now, we come back to the sampling once more. They are telling you that ISAT 530 audit sampling tests. You want to test the sample size now. State that the objective of audit sampling is to give the auditor a reasonable basis for his conclusion about the population from which the sample is drawn. The auditor is not interested in the result from the sample itself. He is only interested in it as a basis for reaching a conclusion about the whole population and the rest. What they are saying is that, and that test. In sampling, when you select the sample size and you test it, you are not interested in the sample size that you have tested, but that sample size is guiding you to conclude on the whole population. That's where you are interested in. Factors to consider when selecting item for what? Item size, sorry. When designing an sample, the auditor is required by ISAT 530 to consider the purpose of the audit procedure. So before you select item, consider the purpose of the audit procedure and the population from which the sample will be drawn. So when you want to select, look at the purpose of the audit procedure and look at the population. Take them into consideration. Then determine a sample size sufficient to reduce what? Sampling risk to an acceptably what? Low. So pick a sample size that is enough to reduce the risk of what? Sampling to an acceptable low level. Then select item for the sample in such a way that each sampling unit in the population has an equal chance of being selected. Okay? The auditor will therefore have to make a number of key decisions. One, the sampling approach to be used. Are you going to use statistical sampling or non-statistical sampling? So that is our decision. The characteristics of the population from which the sample is to be done. So what are the characteristics? Do they have unique characteristics or any figure? Then the sample selection method. Which method are you using? Then what constitutes a misstatement or deviation? And then the tolerable misstatement or rate of deviation. When they say tolerable misstatement, it means there are some misstatements that you can easily what? Tolerate, allow. That's allowable misstatements. And those that are not, then the expected misstatement or rate of what? Deviation. So we have statistical sampling, which is any sampling approach that involves what? Random selection and applies probability theory to the evaluation of the sample results and the measurement of what? Sampling risk. So we have different kinds of statistical sampling you can use. Statistical sampling, non-statistical sampling. The non-statistical sampling is also known as judgmental sampling. The population is defined by ISAT 530 as the entire set of data. Entire set of data from which a sample is to be what? Selected. And about which the auditor wishes to draw conclusion. You know, in selecting items, the group of items that you want to select few from, it's called a population. And that population is what we are talking about. So a wide range of sample selection methods is available to the auditor. Random sampling is one of them. Random sampling is one of them. What is random sampling? All items in the population have an equal chance of selection, being selected. Then systematic sampling. With systematic sampling, a random starting point is what? Choosing from the population, and then items are selected with a standard gap between them. So that is what? Systematic. Every 2 items or every 10 items. So number 1, if you pick 1, then you add another 10 in that order. You add 10. You add 10. Okay? Then haphazard sampling. The auditor selects items on an arbitrary basis. For example, choosing any 100 items from a file. How for that one, anything. You open the file, anything that comes to your mind, you just pick them That's haphazard or sampling. Tolerable misstatements. Yes, there are some misstatements that are tolerable. So they say tolerable misstatement is a monetary amount set by the auditor in order to address the risk that the total of individually immaterial misstatement may cause the financial statement to be what? Materially misstated. So that's tolerable misstatements are misstatements that are tolerable or allowed. Then tolerable rate of deviation is a rate of deviation from prescribed control procedures, which the auditor is prepared to accept. It can be 5% and still be able to conclude. So 5% of debtors, 5% of net asset, and so forth and so forth. Analytical procedures. It is important to remember two key points when dealing with analytical procedure. The evidence generated is what? Supplementary to evidence gain. So apart from what? The evidence you have obtained, you do analytical procedure to also obtain evidence. The basic objective for analytical procedure is to allow the auditor to assess whether the reported figures make sense in the context of what. That's how you do analysis to see whether what is on the ground is exactly what the analytical procedure is also giving you. So analytical procedure is done in such a way that you find out whether the analysis usually consider both comparisons and relationships. Comparison last year against this year, or last 2 years against last year against this year. So you see trend analysis. Then we also have analysis comparing company A to company B, or industry average against our company average. In that financial information in the draft financial state is often what? Compared with a benchmark. So all these things are done as part of the evidence gathering processes. Analytical procedures in the audit process. They must be used in planning the nature, timing, and event intent of what? Other audit procedures. So analytical procedures are done at the planning stage as well. They may be used as substantive procedure also. They can also be used, must be used as at the overall review stage. So when you finish the audit, you want to come to conclusion, you can use analytical review also as part of your what? Audit conclusion. So they are saying extent of what? Analytical procedures. So you must determine what? The suitability of particular substantive analytical procedure for given assertions. Develop an expectation of recorded amounts or ratios, and then evaluate the reliability of the data from which the expectation has been developed. Investigation of fluctuations. So now that you have done an analysis and you have done an analytical procedure and there is a deviation, you need, or fluctuations, you need to investigate them. So that's what they are saying. Fluctuations are significant changes in what? Financial ratio or trend compared with what? Previous financial years. Then explanation must not be accepted at face value. Yes, when you do analysis and there are deviations, you don't just accept the explanation in the face value. So you need to go further. Therefore, if the auditor finds fluctuations or relationship which are inconsistent with other information, acceptable levels of what? Level of differences from expected amount. Then ISA 520 require him to make inquiries of management. So if there are deviations or there are fluctuations, you need to find out from management, make inquiries of management, and verify management responses. So when you make inquiries, they must also respond. If the inquiries are in a waiting form, please put them in. They say everything must be documented. So you have to document your what? Inquiry, and then you must also what? They must also respond to you in written. Perform other audit procedure if necessary or when necessary. Now we come to documentation. Everything needs to be documented. As an auditor, we are not farmers, we just go and then start reading. Where Amma Mansa, who passed by and saw you early in the morning, preparing to start the work, in the evening when she come back, she sees you you have weeded about 2 plots. They say, hey, this guy has this done very well. Auditors, when they are auditing, the only thing that will show that they have done the work is what? Their documentation. So you need to document all your activities, all the audit steps you take. Audit documentation. Through the documentation, we have what we call working papers, audit working papers. So all audit work must be properly what? Documented and held in the audit file. So we have audit files, permanent audit file, and a current audit file. The documentation provides a rule for what? A record of what? The audit procedures performed. So the steps you have taken need to be documented. And that will be in the document. Audit evidence obtained. All the evidence you have obtained should also be documented. Then conclusion reached. What is your conclusion on those evidence? Then the documentation must provide sufficient and appropriate record of the basis for the audit report and evidence that the audit was planned and performed in audit in accordance with what ISIS and applicable legal and regulatory requirements. So what I have to tell you is that as far as auditing is concerned, from day one, everything you do, you need to document them. And that will show that really you have done audit work. Because as I discussed before already, when the auditor is working, he just moves from office to office. You see him carrying files here, pen drive here, a laptop here, but you don't know exactly what they are doing. But if you open their working paper files, then you know the type of work they have done. So everything needs to be documented. Reasons for preparing sufficient appropriate audit documentation. Why there is a need for preparing those documents? Working papers, current working paper, and then what? Permanent working paper. Preparing sufficient appropriate audit documentation on a timely basis helps to what? Enhance the quality of the audit. Enhance the quality of the audit and facilitate the effective review and evaluation of the audit evidence obtained and conclusion reached before the audit report is finalized. So you go through all your working papers and all the evidence you have obtained, and then those things will give you confidence that you have arrived at the best conclusion. Documentation prepared at the time of the audit is performed is what? Likely to be more accurate than what? Documentation prepared later. What I just tell you is that as you go and then you are doing the job, be documenting. You don't wait until you finish the work before you come and say, I'm documenting. You will forget some of the steps you have taken. Other purposes of audit documentation include other reasons where there is a need for audit documentation. It assists the audit team to plan and perform the audit. Have you seen it now? Yes. Now, assisting supervisors in directing and supervising audit work. Your supervisors will also be reviewing your work. And how can they review if you have not documented? So it assists them to what? In directing and then supervising audit work. Then it ensuring what? Members of audit team are accountable for their work. So if you work in a payroll, you document. That shows that you are responsible for that. It makes you ownership. It makes you accountable. Keeping record of matters of continuing vigilance to future. Yes, you have permanent working papers and then what? Current working papers. So you file them according to the various one, and it will what? Keep you in the heart in knowing your future audit assignment, how you are going to approach it. Enabling an experienced auditor with no previous connection with the audit to conduct quality control reviews or other. So it makes anybody who is an auditor who is not related to that particular audit can easily review your work and know the steps you have taken, all the evidence you have obtained, and the conclusion you have reached in those areas. Form, content, and extent of audit documentation. The form that it will take. So audit documentation may be recorded on paper or on what? Electronic or other media. Nowadays, we don't have this work, paper, writing the audit documentation on paper. But still, people do it. So you need to document it, either electronically or what, any other means. The audit documentation for specific engagement is what? Assembled in an audit file. The precise content of the audit working papers varies depending on the nature and size of the client and the complexity of the audit process required to reach the conclusion. But include what? Include audit programs. The things that you need to document. Audit programs. What therefore is an audit program? Audit program is a step-by-step written instruction by a superior officer to guide the junior officers in the approach of their audits in the various areas. So audit program will guide you. If you're auditing stores, there will be audit program on the stores, how to audit the stores. There will be audit program on how to audit payroll. So these are the step-by-step written instruction to you as to what you, when you go to the field, what you do. That is what we call audit programs. Analysis, as we all know, analysis. This year versus this versus this, and that kind of things. Summaries of significant matters. Yes, all significant matters will be recorded, so documented. Then letters of confirmation and representation. That's when you have confirmed some things from outside or within the organization. They will all be on the file. And then if there is any representation from management, it will also be there. And there should be checklists. And then correspondent, any correspondent also be there. The auditing, that's audit files are divided into two, as I told you already. You have the permanent file and then the current file. The permanent file records information that is likely to be of significance to every annual audit of that client. So any information that will be relevant today, tomorrow, and tomorrow next, go into the permanent file. And any information that happened to this year, and that's the end of it, go into current file. The current file contains information of relevance to the current year's audit. Yes, computer generated audit working papers. That's also another area. Yeah, auditors use computer software on their laptops to improve the efficiency of preparing audit working papers. These software packages can be used to help the auditor prepare analysis schedules, lead schedules, draft financial statements. Now, we come to the ownership, custody, and confidentiality of audit working papers. Please, the audit firm has ownership of the audit working papers. That is, it is your working paper, therefore it's yours. Then the papers are not a part of the client's accounting records and do not belong to the clients. So that's what they're telling you. The working papers do not belong to your clients. So if there is a case study and they ask you, your client is agitating that those information you are keeping on your working papers are theirs, then it means you have to advise them. The auditor needs to decide how long to keep the audit files. Now, the audit files in Ghana are kept for minimum of 5 years. Minimum of what? 5 years. Before you can do away with it. Above 5 years, you can decide. So that is it. Related parties. In auditing, we also have to consider related parties. What is a related party? What therefore is a related party? Related parties and related party transactions. These areas are very contentious areas that need to be considered by all auditors. Related parties are individuals, organizations that might have or might be expected to have undue influence on the company that is being audited. So there is a company that is related to your client. So the undue influence that it may have on the client, that's what we call related party transactions. So any transaction in that form is a related party transaction. Example of related party transactions include the directors and key management of a company, their families, other companies controlled by directors, and then other companies in the same group. So those are the related party people. So if you have a related party transaction, it's a very important area you have to Impact on the audit of related party transactions. That is the impact we are talking about. The objectives of the auditor with regard to ISA 550 are to obtain understanding of the entities related party transactions. So we say it's your duty to understand what the related party relationship and transactions, and be able to get sufficient appropriate audit evidence about whether related party relationships and transactions have been what? Appropriately identified. So every company is supposed to disclose to you, the auditor, related party transactions accounted for and disclosed in the what? Financial statement. So any related party transaction should be what? Disclosed in the financial statement. The understanding must be sufficient for the auditor to be able to what? Recognize fraud risk factors arising from related party transactions. Yes, they are saying that related party transactions are dangerous, so that if they disclose them, then you can recognize fraud risk factors arising from the related party transactions. And then you conclude whether the financial statements achieve their fair presentation in respect of related party transaction, relationship and transactions. The requirement for ISA 550. ISA 550 therefore set out a minimum set of risk assessment procedures. So as an auditor, ISA 550 has set a minimum of what? A minimum set of risk assessment procedures particularly directed towards the identification of related party relationships and transactions that have not been identified or disclosed by management. So it is management responsibility to identify related party transactions. And you, the auditor, ISA 240 and 315, the auditor is required, this is your duty now, to perform the following procedures in order to understand the entities related party relationship and transaction. 1. Consider the risk of material misstatement due to fraud or error arising from what? Related party relationships and transactions. That's your function. You must also make inquiries of management in respect of what? The identity of what? Related party. Have they identified related parties? If they have, then they should disclose transactions that went between them and disclose them. The nature of relationship with those related parties and the nature of any transaction entered into with those parties during the period. And then you must obtain understanding of the internal controls in operation. Yes, since it's a high risk area, you need to understand the internal controls in operation over these things, over the identification of, accounting for, and disclosure of what? Related party relationships and transactions. The authorization and approval of significant related party transactions. The authorization and approval of significant transactions outside the normal course of business. What they are just saying is that it is your duty to what? Obtain understanding of the internal controls. They put in place, management put in place. Over what? Identification of, accounting for, and disclosure of what? Related party transactions. Related party relationship transactions. All right. And then the authorization approval of significant related party transactions. Who authorize it and who approve it? And then the authorization approval of significant transactions outside the normal course of business, which is not the normal procedure, but some transactions can happen. Then their responses to the risk of material misstatement. What is the risk? How do they respond? ISA 550 requires the following audit procedures. If the auditor discovers previously unidentified or what? Undisclosed related party. So if you have disclosed or you have found that there is what? A related party transaction, what are the steps you take? Then you first determine whether the underlying circumstances confirm the existence of those relationships and transactions. Confirm it. Then the second one is communicate the relevant information to the audit team. Let the audit team be aware that there is a third-party relationship and there is a transaction. Let them be aware. They request management to identify all transactions with the newly identified related parties. So you have to ask management to now tell you what are the transactions that went between on between the two of the related party and your company. Inquire as to why the entity's system fail to identify or disclose these related party transactions. So if find out why the entity's system failed, then perform appropriate substantive procedures on the newly identified related party transactions. And if the non-disclosure appears intentional, evaluate the implication for the audit. Now, materiality of related party transactions. Materiality. How? ISA 450 revaluation of misstatement identified during the audit requires the auditor to consider both the size and the nature. The size and the nature of what? Requires the auditor to consider both the size and the nature of a misstatement and the particular circumstances of its occurrence when evaluating whether a misstatement is material. So that is your duty. Other requirements. You need to what? Obtain a written representation from the directors that the completeness of the information that has been provided about the identity of a related party and party relationship and transactions. What they are saying is that you need to let management give you a representation about the related party, that all the related party they are aware of, those are the ones they have given to you. Then the adequacy of accounting for and disclosure of such related party relationship and transaction, or all transactions that went between them. This is what they have given to you. Now, the written representation is a statement written by management to auditors. It's written by management to auditors. But under normal circumstances, it's the auditor who drafts it and give it to the management to put on their what? Letterhead and giving back to them. So, definition and objectives. So, objectives of the auditor in this area per ISA is that you should obtain written representation from management that it has fulfilled its responsibility in respect of what? Financial statement and the audit. So it is the letter of representation written by management to you, the auditor. This number one. There should be what? You should obtain written representation from management that it has fulfilled its responsibility. Management responsibility, they have fulfilled it. And then they should obtain written representation as appropriate to support other evidence. Any other evidence you want, written representation should be obtained. And then you should also have representation provided by management, or if management refuse to provide the representation requested. So what step will you take? So ISA 580 requires the auditor to obtain written representation from management, often referred to as management representation in the form of a letter of representation addressed to the auditor. So I told you already, the representation is from the client's management to the auditor. But under normal circumstances, we draft it for them to go through, put it back on their what? Letterhead. Written representation as audit evidence. So there's another reason. If the auditor considers that written representation are needed to support other audit evidence, he must request such other written representations. Such representations are likely to be needed. Yes, if you have obtained any audit evidence which you are not sure of yourself, you need a clarification from management, and that clarification should go through the management representation, which we know that it's a letter from the management to you, the auditor, to support the auditor's understanding of management intention or judgment in respect of what? The completeness of specific item. Okay? However, although such representations provide necessary audit evidence, they do not provide sufficient appropriate audit evidence on their own. So a question can be thrown to you that you have obtained all the audit evidence, but you couldn't get sufficient appropriate audit evidence, and you have obtained a representation from management. Representation from management, and they are telling you that those audits, written representation, they do not provide sufficient appropriate audit evidence on their own. They need to be supported with other evidence. Now they say written representation about management's responsibility. So in this representation, management acknowledges that he has fulfilled its responsibility and the rest, and then it has provided the auditor with all relevant information. All transactions have been recorded and are reflected in the financial statement. So that's how it goes. Form and content. So these are the form and content of the management representation letter. They say letter of representation is usually drafted by the auditor. I said it already. Okay. As he knows the areas on which he requires the written representation and addressed to the auditor, dated as near as practicable. Okay. Now, refusal to provide requested written representation. If management refuses to what? Provide written representation from the auditor, then there are steps to be taken. Discuss the matter with management. Discuss with them the consequences of what? Failure to provide the written representation. Discuss with them. Then reevaluate the integrity of management and reconsider the impact on other representation and audit evidence. Once they are not able to give you their representation, reconsider it. Evaluate that integrity of management first. Are they taking the decision? What about the previous evidence that they have given to you? That's what they are saying. Then take appropriate action, including considering the effect on what? The audit reports. It may have effect on the audit reports, so consider it. Oh, shit. Using the work of an auditor's expert. Who is an auditor's expert? Let's see. Definition of an expert. Auditor's expert. Yes, using the work of an auditor's expert, give a number of examples where experts may be used by an auditor. These areas, like legal opinions, we have auditors experts there. You can rely on an expert there. Specialist valuation areas, such as property or pension liabilities. The analysis of what? Complex or unusual tax liability compliance issues. These are the areas that we auditors rely on what? Experts. The situation where management used the work of an expert was covered. Okay, that's one already. The objective of ISA 620 is to allow the auditor to decide whether to use the work of an expert and assess whether that work is adequate. That is your work. Will you rely on an expert as an auditor? And if you are going to rely on it, whether that work is adequate for your purpose. Now, assessing the need for an expert. When deciding whether there needs to use an expert to assist in him in what? Obtaining sufficient appropriate evidence, the auditor should consider such factors as what? The nature, significance, and complexity of the matter, the risk of material misstatement, the availability of alternative sources of audit what? Evidence. ISA what? 620 require the auditor to assess the competence, capability, and objectivity of the what? The experts. So once you want to rely on an expert for your evidence, then you need to what? Assess the expert in the what? Competency, capability, and objectivity. This may be assessed in one or more of the following. Personal experience with the previous work of that expert. Yes, you might know somebody who is an expert. Your previous knowledge about that fellow. Then discussion with that expert. Discussion with other auditors or others who are familiar with that expert work. Knowledge of that expert's qualifications. Membership of professional body or industry, association, and the rest. Then publish paper or books written by that experts. Wow. Hey. How many pages left? Halfway. The work of an expert. The auditor shall obtain understanding of the expert field of what? Expertise. Sufficient to allow the auditor to what? Determine the nature, scope, and objectives of the expert work. Agree the terms of engagement with the experts, and then evaluate the adequacy of the expert work. Then, generally, the auditor is assessing whether the expert's work constitutes sufficient appropriate audit evidence. If the auditor decides that the audit work the work of the expert is not adequate, he is required to what? Agree additional work with the experts, and then what? Perform other appropriate additional audit procedures. Yes, reference to the auditor's expert in the auditor's report. The auditor has no sole responsibility for the audit opinion. So you have sole responsibility for your opinion that you have issued. And this is not reduced in any way by his use of an expert. So whether you use an expert or not, your opinion is yours, solely yours. So it's not necessary to mention the experts in it. Therefore, he should not refer in his report to the use of what? An expert, unless that is required by law or regulation. Now, external auditors also rely on internal auditors. So how do you rely on it? So likewise, like the way we studied how to rely on experts, the internal auditor is an expert in his field. So let's see how you are going to rely on an expert. That's the internal auditor. Rely on internal audit. The external auditor's problem. That is the problem with the external auditors. They want to rely on the internal auditor's work. The external auditor is responsible for his opinion on the financial statement. The previous slides discussed the reliance on what? Experts. So in this case too, in that previous one, we were told that your expert's work you shouldn't refer to it in your opinion. Likewise, are like internal auditor. So they are saying that the external auditor is responsible for his own what? Opinion on the financial statement, even if he has relied on the work of what? Others, such as internal auditor and external experts. The responsibility for relying on work done by the internal auditors rests entirely with what? The external auditor. So it is your duty to know who you are relying on using the work of internal auditors. Now, we know the internal auditors are to find out whether and how the objectives of external auditor are then to decide whether and to what extent to use specific work of the internal audit. Yes, whether to rely on the internal auditor, and if you want to rely, which part of the work are you going to rely on? If so, whether such work is adequate for the purposes of what? The external work. So that is another decision you have to take. To determine whether such work is adequate for his purposes, the external auditor is required to evaluate the internal audit function and its procedures. So if you decide to rely on the internal auditor's work, you need to what? First of all, find out whether the work done is adequate, and then you can rely on it. The following factors need to be considered by the external auditors when you want to rely on what? Internal audit. First, the status of what? The internal audit department within the entity. Status. The level at which the internal auditor is placed. Who does he report to? That's what they mean by that. The technical competence and due professional care of the internal auditors. Let me take the first one here. The status of the internal audit department within the internal auditor should be a line manager. So you should not report to any manager under the hierarchy of what? Like the internal auditor reporting to the chief accountant. No. It's not allowed. So that is the status of the internal. If he's reporting to the board of directors through the internal, audit committee, that is fair. But for the internal auditor to be reporting to the financial controller, then automatically you can depend on that way. So they are saying the status of the internal audit department within the entity. Then the technical competence and due professional care of the internal auditors. Those who are working there, their competence and their professional due care there. There will need to be effective communication between the external and the internal auditor with meetings held at appropriate intervals before you can rely on their job. You need to have meetings with them. Now, we come to another evaluation question. Evaluating. We are evaluating, so let's go. Now, accounting estimates. ISA 540. Accounting estimates. As we all know, estimates, they are not precise figures. They are figures that have been predetermined, but they are not precise. Therefore, more or less, we can term them to be provisions, temporal. So ISA 540 defines an audit estimate as what? An approximation of what? A monetary amount in the absence of a precise means of what? Measurements. So they are not precise. All right. So estimates. Accruals, prepayments, depreciation are all examples of what? Areas where estimates are widely used. Other examples are the estimation of tax, deferred tax, and provisions for settlement of unfinished legal disputes, etc., etc. ISA 540 gives the following examples of accounting estimates. Allowance for doubtful debts is another one. Inventory obsolescence, warranty obligations, depreciation methods, or assets useful life, costs arising from litigation settlements, the provision against the carry amount of an investment, and the outcome of our long-term contracts. All these are, then additional examples are complex financial instruments which are not traded in on active or open market, share-based payments, property or equipment, and all these things are estimates. Then, as part of his risk assessment procedures, ISA 540 required the auditor to obtain an understanding of the following: the requirement of the applicable reporting framework, how management identify transactions or events that could result in an accounting estimate being recognized, then the nature of the estimates. Then the auditor should also review the procedure used by management to make their estimates, if possible, to assess whether the estimated amount seems reasonable. So that is what the standards have given to you as an auditor. You must, first of all, you must find out the requirement of applicable financial reporting framework, how management identify transactions or events that could result in an accounting estimate, and then the nature of the estimates, how the auditor should also reviews procedures used by management to make their estimates and possible, and so forth and so forth. Then the following examples indicators of possible management bias in estimates are given in there. So these areas, the ISA is saying that if you look at all these things, there are some biasness in some areas. Changes in accounting estimate or the method for making it, where this is a subjective assessment. Then use of an entity's own assumption for fair value accounting estimates. Selection or construction of significant assumption that yield an estimate which favors management objectives. Selection of an unduly estimatic or pessimistic estimates. Auditing of fair value measurements. Auditor needs to recognize the audit risk in fair value. Inherent risk. You have to, first of all, know that there are inherent risks in fair value audit. Many fair value measurements are largely subjective and precise because they are estimates. And there is unavoidable inherent risk in their measurement. Okay? In the fair value, the inherent risk is much less when an open market exists for the items measured at fair value. Okay? You have control risk as far as fair value is concerned, and then you have detention risk. So, International Audit and Assurance Standard Board alerts challenges in auditing fair value accounting estimates. So they did some research and they came out with an alert, which in actual fact is saying that the alert is relevant to audit of all entities that have investment in financial instruments, especially those in what? Liquid markets. The alerts are challenges faced in accounting on the basis of fair value. So these are the matters. If your client is say that their accounting is done in a fair value, key matters that you need to consider are challenges faced in accounting on the basis of fair value, requirements and guidance in standards that are particularly relevant to fair values, other consideration in audit of fair value, and then initiatives of the International Accounting Standard Board, recent revisions to extend standards on auditing, accounting, estimates, and fair values, and so forth. So let's go to the audit of specific areas of the financial statement. Why specifics? You will then need to consider materiality. Is the item material for the financial statements? Key requirements of International Financial Reporting Standard or International Accounting Standard. What does the auditor need to test to ensure compliance? How to obtain suitable audit evidence to check compliance with the accounting standard. So let's go to presentation of financial statements. Has the going concern basis been adopted? If yes, is the going concern basis appropriate? These are the questions you ask yourself. These are the checklists. If the directors of the client company have decided that the going concern basis is not appropriate, have the relevant disclosures been made? Have they made the relevant disclosures? If there is uncertainty about the going concern status of the company, have the relevant disclosures been made? So all these questions, before you conclude, these questions must be: has the accruals consent been complied with? Is there consistency in the presentation and classification of items in the financial statements between the current and previous financial periods? Has each material class of item been separately presented in the financial statement? All these are the questions you have to ask yourself before. There has offsetting of assets and liability, that's offsetting, been apply only as permitted by an accounting standards? Has an appropriate format been adopted for the statement of financial position, income statement, and the rest? Are appropriate disclosures notes included? If you come to International Accounting Standard 2, inventories, the issue that you must find yourself in: has inventory been consistently valued at the lower of cost and net realizable value? If not, then you know what you have to do. Has an acceptable costing method been used for inventory? Other FIFO, remember that LIFO is not permitted by International Accounting Standard 2. Has inventory been counted accurately? What is the evidence for this? All these things are questions you have to ask yourself. Has an appropriate method been used for the treatment of overheads? And statement, International Accounting Standard 7. The question you ask yourself is: statement of cash flows. Is the presentation of the statement of cash flows in accordance with the requirements of International Accounting Standard 7? Then you come to what? International Accounting Standard 8. All these are just review work you do before you come out with what? Your reports. They are review work. Have appropriate accounting policies been selected and consistently applied? If yes, then you go on. If no, why? Then that's where you are coming to conclude and write. Have any changes in accounting policy permitted under International Accounting Standard 8 been correctly accounted for as prior period adjustments? Have fundamental errors in prior period financial statements been accounted for as prior period adjustments? Have changes in accounting estimate? All these are just questions you ask yourself. They are the accounting areas which you have to look for. Look at Accounting Standard 10, events after a reporting period. Has the definition of events after the reporting period been properly applied? Have they complied with? Is there any correct distinction between adjusting and non-adjusting events after the reporting period? Have adjustments been made correctly for adjusting events? Have non-adjusting events been adequately disclosed? All these things, they should be yes, yes, yes. Or if not, then those are the areas you have to look for. Then look at International Accounting Standard 12, income taxes. All these areas, they are all questions. Then property. International Accounting Standard 16, property, plant and equipment. Has the cost of property, plant and equipment been determined in accordance with what? International Accounting Standard 16. Has cost been correctly allocated to components of an audit asset in a? All these are questions you need to ask yourself. Then you come to employee benefits. Have appropriate liability been recognized correctly when employees have been provided service in exchange for what? Employee benefit to be paid in the future. Has the expense of the entity consuming the economic benefit arising from service provided by employees in exchange for employee benefit been recognized correctly? If all these questions, if it is yes, and you are correct, then you tick it. Where there are those, you need to do follow-up. Accounting for government grants and disclosures. The questions are there. Have revenue-based grants been credited to income statement or statement of comprehensive income at the same time as the related expenditure? So all these questions. Then, the National Accounting Standard 21, the effects of changes in foreign exchange rates. Have appropriate exchange rates been used in generating exchange? All these are questions you have to answer. Borrowing costs. Have borrowing costs been recognized as an expense in the period in which they are incurred? Yes. If no, then there are a missing link there which you have to look for. Then it will affect your opinion. If borrowing costs have been capitalized, are they directly attributable to what? To the acquisition, construction, or production of what? Qualified assets. So all these questions need to be answered. Related party disclosures, as we discussed already. Have necessary disclosures been made to draw attention to the possibility that the company's financial position or profit or loss has been affected by related parties and related party transactions? All these are. Then we come to 26. Retirement benefits. Retirement benefits. Then we come to financial reporting in hyperinflationary economies. You ask yes, no, yes, no, yes, no. Once it's no, you have to go further. If it is yes, it's complete. Earnings per share. Diluted share. Impairment of assets. Have the directors identified events that may indicate that an impairment review is necessary? If yes, then the evidence should be there. If no, then you have to go further. Have recoverable amount been calculated in accordance with International Accounting Standard 36? So in that order, provisions, contingent liabilities, and contingent assets, all these ones. Intangible assets, financial instruments, investments, property, all these things. There are questions and answers you need to ask yourself before let's see the areas. Share base, non-current assets held for sale and discontinued operations. Has the definition of discontinued operations in International Financial Reporting Standard 5 been properly applied? So all these things, you have to find answers to them before financial instruments, operating segments, and all regulatory deferral accounts, all these things, revenue from contracts with customers, etc., leases, insurance contracts. Let's see. Okay. audit papers, audit procedures, and audit matters. It is what? It is highly probable that a question in your examination will ask you to describe the audit procedures in relation to specific issue in the financial statement, or to comment on audit matters that should be considered in relation to a particular item. So all those standards which we just went to, yes and no, yes and no. A question may be asked on any of them. That's what they are saying. So practice all those questions and see. You must understand them. Once you read them and understand, then it means, let's go. The question may therefore ask any of the following. What audit procedures should be carried out in respect of, then they mention it in. Then, what audit evidence will you expect to see in relation to? Okay. Then, what matters will you consider in respect of? So, all these things are then transaction cycles. Transaction cycles. Inventories. Now, when it says transaction cycles, what it means is that you take inventories. First of all, inventories need, if inventories need, an organization needs an inventory, there should be a request for that. There should be a need. So there should be a request. Then it go for purchasing. Purchasing, then it comes to stores, receiving. Then the store keep it. Then it is issued. Accounts pay for it. Then it go back again. So that is the cycle we are talking. Many of the points listed above in relation to the purchasing cycle and the sales cycle should also apply to the inventory cycle. For example, the requirement for authorization procedures and segregation of duties are the same. Non-current assets. Assets which are not current, okay? Again, some of the controls and tests that are listed above are also relevant here. So those are the tests. Yes, no, yes, no, yes, no. Thank you very much.